I'd like to look at the advantage of this. An obvious advantage is that you get paid for your accounts receivable,
Sure.
but that's not the end of it. There are two other things I'd like you to talk about. One is, you brought this up when we were talking before we started recording, is if you have the ability to get paid in a credit process, you might accept customers you otherwise would not have. Not just because you can push it off on Allianz, but because you've got processes and your business might increase because you're not worried about the credit risk.
Sure.
And then I want to make sure we talk about how banks look at insured accounts receivable, as opposed to you just walking in and say, hey, I got a bunch of receivables, lend me money on it.
Right.
So maybe you could talk about those too. I think you had some stories about people who increased their business because insurance gave them confidence.
Sure. Yeah. So, when you write this type of coverage, the last thing you want to be selling on is paying claims, right? In my 10 years, and I've done a lot of prospecting, it's very rare that I call somebody up and they say, man, I really need you because we're writing off a ton of bad debt, right? And as an insurer,
Sorry, I can't hear you. I'm in a bad cell zone.
yeah, and as an insurer, that's not the type of person that we necessarily want to insure, right? It's like State Farm doesn't want to find the guy that wrecks his car 5 times a year. But a lot of people, they hear credit insurance, and that's naturally what they progress to is, oh, credit insurance, what is that? Well, oh, you insure accounts receivables? Well, we don't really write off a whole lot, so we don't need that, right? So I deal with that objection all the time. A couple of things, people don't know how much this costs, so it's very difficult to make an educated decision as to whether there's any value in it if you were going to base it solely on losses, because you don't know how much it costs, right? And you do know what your bad debt is, so it's a good idea to get an understanding of the pricing. But throw losses aside, and there's really 2 or 3 other key drivers why people use something like this. One would be, which is probably the big driver for a lot of my clients, is it helps support sales growth initiatives. Okay, now when people tell me they never lose money, depending on what type of company, I generally find that people that very, very rarely take losses are probably very diligent in the credit underwriting process for their new customers, right? So if something doesn't look great, they just say, hey, we're not going to take them on as a customer. We're going to make them prepay with a credit card, which they're giving up 3% of their revenue, okay? So I find that people either are losing money one of 2 places, either top line sales growth opportunities because they're too tight with credit, or they're giving credit to everybody, and then they are probably posting some losses. And so we're kind of the best of both worlds. We give them the ability to do both. But back to the sales expansion point, we'll just take a smaller company. We'll take a company that might carry, $300,000 or $400,000 in AR with a group of customers, and say he runs into a really sizable sales opportunity that might throw another $1 million in AR on top of that. That's a big, big exposure for a small company. Small company may not be very comfortable with that big exposure, knowing that if that $1 million guy doesn't pay him, he's probably closing his business, right? So having our protection with a large exposure like that can help a small guy take on business that he may not be comfortable with due to the size of the exposure, assuming that we can underwrite it, or even just for your everyday type of a company that is tight on credit. If you're laying the risk of non-payment off on us at the cost of 0.25%, well, now I can get you more comfortable taking on clients that you weren't comfortable taking on, because I'm giving you that guarantee of payment and you're giving me 0.25%. So even in the thinnest margin industries, which we work with a lot of them, a lot of people that work in thin margin industries like lumber, metals, oil, fuel, produce, the food space, these types of guys use credit insurance because it enables them to feel more comfortable extending more credit to people.
You got really low margins and you suffer a loss, it wipes out a large amount of sales that you've done.
Absolutely.
It takes a lot to get it back.
Absolutely.
Yeah, I don't think that's obvious at all. We have and I want to get to the banks.
Yeah, sure.
But we have maybe he's been on before this, we had a bonding agent on.
Sure.
I have no idea if this works, but bonding agents pay your customer, not you.
Right.
But if you have receivables insurance, I don't know if that would affect your bondability or not, but that's clearly off the top.
Yeah.
In other words, a
don't know
bonding
how-
insurance,
Sure.
bonding agent's more likely to recover a payment if you have insurance. Anyway, that's
Right.
off the topic.
Sure.
The other question was, how do banks treat this? You know,
Sure.
you walk in with receivables and your banker goes, I don't know these guys. I'll give you half,
Yeah.
50% or 40%.
Sure. Yeah.
What effect does it have on banks?
Yeah, well, I can't speak for every lender out there. Everybody has their own lending guidelines and their own credit committees and comfort level of what they're comfortable with. Generally speaking, most lines of credit that are being secured with assets, generally assets are going to be inventory and receivables. Some of the banks here might be trying to stick a piece of real estate to it, on it, or personal assets, vacation home of the business owner or whatever to secure the loan. But, on a loan where they're just using inventory and receivables, they're generally giving you availability on what you're carrying in inventory and what you're carrying in AR. Now, every bank has a different
Yeah,
calculation.
you said availability.
Availability on your line of credit. So we'll
Oh,
say
what
that.
is it?
Yeah, so we'll say they've given you a line of credit and they're using your inventory as collateral and they're using your receivables as collateral. Okay, different types of inventory have different advance rates, but so you've got $500,000 of metal sitting in your shop. A bank might say, well, that metal, we could probably move that pretty easily if you were to default on your loan. So maybe they give you 50% of the value of the metal on your borrowing base, okay? With the receivables, generally speaking, they might be giving you 70% because although receivables is an asset, as of right now, it's just still a promise to pay and it's not actual cash. So they may say, well, you've got, 500,000 in AR out there. And so we're going to advance 70% on that AR. So that gives you $350,000 of availability on your line
Okay.
of credit. Okay. Now, if I can insure that AR, you can make the bank the beneficiary of the policy. And now most lenders will bump your advance rate up on the AR from say 70% to 80% or 80% to 90%. So some lenders will go up to 90% on insured AR versus uninsured AR.
I'm just a little surprised that you used 70%. I didn't think that generally they'd loan that much against ARs. But
Yeah. I mean, a lot of it depends.
Depends on the bank,
Yeah,
not
it depends
us.
on the bank. Some of the larger banks, I mean, they're probably pretty standard at 80%. Another thing that banks generally will kick out of the borrowing base are concentrations. So if you're pledging your receivables as collateral and more than one customer makes up more than 25% of the total AR, banks will call that a concentration. And so a lot of times, depending on who the concentration is, they will either discount that receivable significantly, or they might just kick it completely out of the borrowing base if they're not comfortable with it.
good point.
So
Makes
sometimes I
sense.
will have lenders that will reach out to me and say, hey, we've got this, this borrowing base where our client has, one large customer. I had a guy at metal, actually I use a lot of metals, but I have people everywhere. I have
Yeah.
people in all sectors, but metals just came to mind. But, I had a guy that was a metals guy, had a large customer. He was carrying about 3 million in AR. Of the 2 million of it was with one customer. So that posed a big concentration for the bank. And it was a privately held company, so the bank had no visibility into the creditworthiness of his largest customer. And so the bank was very restrictive on what they would lend on or advance on that $2 million receivable. They reached out to me and said, hey, this guy is looking for a bump in his borrowing base. Could you look to see if you could underwrite his largest customer? Well, his largest customer, we had financials on him, and we got financials from them quite frequently because we had a bunch of other metals guys that were also selling to them. So they're incentivized to give us their financials when we have a handful of their suppliers that are giving them credit. Does that make
Interesting.
sense?
Yeah.
And so that's what we call the single debtor policy. So we could just insure that one customer, the big, large concentration, the biggest customer, and it satisfies the bank's requirements. It's better for the bank. They have a more secure loan. Better for the borrower. He has higher advance rates. He has more working capital. Everybody's happy.
Named insured.
Named insured. That would be named. Yes.